Last weekend, the United States and Israel struck Iran. They killed Ayatollah Ali Khamenei, and within 48 hours, gold surged past $90 an ounce. Oil hit its highest level in 8 months, global equity markets shook, and Tehran vowed retaliation. That is not a prediction. That is not a scenario. That happened. This past weekend, right now, as you're watching this video, U.S. forces are amassed in the Middle East in the largest military deployment since the Iraq War in 2003. The Strait of Hormuz, through which roughly 20% of the world's oil flows, is under active military pressure. This is the most volatile geopolitical moment in a decade. And here is what almost nobody is talking about. The corporations that manage trillions of dollars in Treasury reserves, the CFOs, the Treasury managers, the board-level finance committees sitting inside Fortune 500 companies right now, they are watching all of this. They are watching gold move. They are watching oil surge. They are watching treasuries wobble and the dollar strengthen in a confused, fear-driven reflex. And some of them are asking a question that would have seemed insane just 4 years ago. Should we be holding Bitcoin? Not as a gamble, not as a moonshot, as a hedge, as a reserve, as a geopolitical shock absorber. Today's video is going to show you the entire chain of logic, from war rooms in the Middle East to boardrooms in New York and London, that is quietly but undeniably pushing corporate money toward Bitcoin in 2026. We're going to break down the macro pressure cycle, the infrastructure shift, the Treasury playbook, and the one scenario that could send shockwaves through Bitcoin's supply that almost nobody is pricing in right now. This is not financial advice. This is financial systems analysis, and it is one of the most important frameworks you can understand right now. Before we get into this, if you've been watching this channel and you want to understand where serious patient capital is actually moving in 2026, stay with me through this entire video. At the end, I'm going to walk you through the one framework that connects everything you're about to see. It's called the wealth continuum, and it changes how you think about your financial future at a structural level. You'll want to see it. Now let's build this from the ground up. To understand why corporations are moving toward Bitcoin, you first have to understand the chain reaction that geopolitical conflict triggers in the global financial system. Because this chain reaction, this exact sequence, is playing out right now in real time. And most people watching the news right now are seeing the surface. What I want to show you is what's happening underneath it. Stay with me until at least 10 minutes, because the connection I'm about to make between Middle East conflict and corporate treasury behavior is not obvious. But once you see it, you cannot unsee it. Here's how the chain works. Step 1. War drives spending. When a major geopolitical conflict escalates, especially one involving the United States directly, defense spending surges. The U.S. is already operating on a Department of Defense budget that dwarfs what was being spent in 2020. And that was before U.S. forces were actively engaged in Middle East operations. War costs money, a lot of money, immediately, without warning, without budget approval cycles. Step 2. Spending drives deficits. As of January 14th, 2026, total U.S. national debt stood at $38.4 trillion in roughly 4 months. From September 2025 to January 2026, the U.S. added nearly $1 trillion to that total. Nearly $1 trillion in 4 months. And now, with a shooting war involving American forces underway, that trajectory only accelerates. Interest outlays alone, just paying the interest on existing debt, surged 15% year over year, hitting $355 billion in the first quarter of fiscal year 2026. The average interest rate on U.S. debt is now 3.32%, the highest since 2009. We are not in a manageable fiscal environment. We are in a fiscal pressure cooker. And here is the part I need you to stay with. Because what this debt cycle does to corporate decision-making is the engine behind everything else in this video. Step 3. Deficits drive bond issuance. To fund a deficit, the Treasury must issue bonds. More bonds mean more supply in the market. More supply, especially when foreign buyers are uncertain about geopolitical risk, pushes yields higher. The 10-year Treasury yield has been whipsawing around 4%. Foreign central banks, particularly in the Middle East and Asia, are reassessing their appetite for U.S. paper. When the very country issuing your bonds is engaged in a shooting war with one of the most strategically significant oil-producing regions on Earth, you do not buy more of that country's debt. You hedge. Step 4. Higher yields create a central bank dilemma. The Federal Reserve is now caught between a rock and a hard place. Markets had been pricing in 2 rate cuts this year. But if oil prices remain elevated, which they will if the Iran conflict drags on, inflation stays sticky. Sticky inflation means the Fed cannot cut. But it also cannot hike aggressively without triggering a credit crisis with $38 trillion in outstanding debt. So they sit, they do nothing. And the clock ticks louder. Step 5. The dilemma ends the same way it always does. with currency debasement risk. When governments cannot grow their way out of debt, cannot raise taxes fast enough, and cannot let rates rise too high, history shows one consistent outcome. They debase the currency. They inflate the debt away. They print. Not necessarily today. Not necessarily this quarter. But the structural incentives point in one direction, and serious corporate treasurers know it. Larry Fink, the CEO of BlackRock, the world's largest asset manager overseeing more than $10 trillion, said it plainly in January 2026. He warned that ballooning U.S. deficits could position Bitcoin and other digital assets as viable alternatives if fiscal concerns continue to undermine dollar confidence. BlackRock's iShares Bitcoin Trust, IBIT, is now sitting at over $54 billion in assets under management. It is the fastest growing ETF in history. When BlackRock tells you the fiscal situation is concerning enough to justify digital assets as a hedge, corporate treasury departments listen. Now here's what I need you to hold on to before we move to the next section, because the macro picture I just described is the backdrop. The real story is what happens when that backdrop collides with a corporate world that is now fully equipped to act on it. And I promise you, what I'm going to walk you through in the next chapter about the infrastructure shift is something that most financial coverage of Bitcoin completely misses. Stay with me. Because the reason corporate behavior in 2026 is fundamentally different from anything we saw in 2020 is not what most people think it is. And if you leave before I explain it, you will not have the full picture. In 2020, when Michael Saylor put MicroStrategy's entire treasury into Bitcoin, the financial world laughed, or panicked, or both. It was seen as reckless, visionary, eccentric, depending on who you asked. In 2026, it is being studied in business schools. But here's the critical thing to understand, and stay with me on this, because this is the part where most Bitcoin analysis gets lazy. The shift is not just sentiment. It is not just price performance. It is not just that Bitcoin went from $16,000 in late 2022 to an all-time high of $126,000 in October 2025. The shift is structural. It is infrastructure. It is regulation. It is board-level approval mechanics. And it is the competitive risk calculus that a CFO now has to run. Let me take you through each layer. Infrastructure shift number one, the ETF layer. For a corporate treasurer, custody and liquidity are everything. You cannot put $500 million into an asset that you cannot exit or that carries operational risk your board does not understand. Bitcoin spot ETFs change that equation entirely. When BlackRock's IBIT launched and hit $70 billion in AUM in 341 trading days, the fastest any ETF in history has ever reached that threshold, it sent a signal to the institutional world that this market had depth, that there was a legitimate exit, that the rails were built. Before ETFs, Bitcoin was operationally alien to a corporate treasury department. After ETFs, it is a line item. Infrastructure shift number two, accounting clarity. The Financial Accounting Standards Board, FASB, changed the rules in December 2023. Before that change, companies holding Bitcoin had to report impairment losses whenever the price dropped, but could never mark it up when prices rose. That asymmetric accounting treatment was a massive disincentive for any public company's CFO. You take all the pain on the downside and none of the benefit on the upside on your income statement. FASB eliminated that. Starting in 2025, Bitcoin is marked to fair value, like any other financial instrument. That single regulatory change removed one of the biggest accounting barriers to corporate Bitcoin adoption, and the boardrooms noticed. Infrastructure shift number three, the U.S. Strategic Bitcoin Reserve. In early 2025, the United States government established a strategic Bitcoin reserve, committing to hold forfeited Bitcoin rather than sell it at auction. Think about what that signal communicated to a corporate board. When the federal government of the United States decides that Bitcoin is worth holding as a strategic national asset, the conversation inside a Fortune 500 company changes overnight. It is no longer a fringe idea. It is national policy. Infrastructure shift number four, institutional custody. Coinbase Prime, Fidelity Digital Assets, BitGo, and multiple bank-grade custodians now have full enterprise-level custody solutions. Wells Fargo, JP Morgan, and BNY Mellon have operationalized lending desks supporting Bitcoin-backed credit facilities. Wells Fargo now permits Bitcoin ETF shares as eligible collateral. When a company can use its Bitcoin holdings as collateral for credit lines, that is not speculation. That is treasury management. Now here is where I need you to stay focused, because the numbers I am about to give you are the foundation for the supply shock scenario. I will walk you through later in this video, and those numbers are going to change how you see this market entirely. As of right now, 194 public companies hold Bitcoin on their balance sheets. Public companies collectively hold roughly 1.13 million Bitcoin. Strategy, formerly MicroStrategy, holds 717,722 Bitcoin as of February 23, 2026, acquired at an average cost of $66,384 per coin, with a total investment of $33.1 billion. Just last week, February 24th and 25th, Strategy held a dedicated Bitcoin for Corporations 2026 conference in Las Vegas, specifically designed to walk Fortune 500 CFOs through the mechanics of Bitcoin Treasury adoption. This is not a niche conversation anymore. This is a boardroom conversation. But here is the thing that most people do not realize, and I need you to stay with me until I show you the full math on this, because the corporate Bitcoin adoption that has happened so far is extraordinarily concentrated. Strategy is responsible for nearly 2/3 of all public company Bitcoin holdings. In January 2026 alone, Strategy accounted for 97.5% of net corporate Bitcoin purchases. That means 193 other public companies combined bought almost nothing, which means the corporate universe is still almost entirely on the sidelines. And I'm about to show you what happens when even a fraction of that sideline capital enters the market simultaneously, motivated by the same geopolitical fear trigger we are living through right now. Stay with me through the next section, because the hedge shift I am going to describe is the bridge between everything I just told you and the supply scenario that Wall Street is not modeling. Do not skip ahead. The logic only works if you see the full chain. Let me show you the historical playbook of how corporations hedge against macro uncertainty, because understanding what they did before tells you everything about why the playbook is changing now. Traditionally, the corporate treasury facing inflationary risk, currency debasement concern, or geopolitical instability had three primary tools. Tool 1, gold. Timeless, liquid, universally accepted as a store of value. When the US and Israel struck Iran last weekend, gold moved from around $5,100 to over $5,390 an ounce in hours. Gold has now gained more than 20% just since the start of 2026, following a 64% rally across all of 2025. JP Morgan analysts now expect gold to reach $6,300 an ounce by year end. Gold is working. Gold is doing its job. But gold has a structural problem for corporate treasuries. It is slow, expensive to store, difficult to move across jurisdictions, and impossible to verify on a ledger in real time. If you are a multinational corporation managing treasury assets across 12 countries, gold is clunky in ways that most gold coverage never acknowledges. Tool 2, short-term treasuries, the traditional safe haven for corporate cash. But here's the 2026 problem. U.S. Treasuries are the instruments being pressured by the very deficits that created the risk in the first place. The 10-year yield has been volatile, falling to 3.96% on geopolitical fear, then jumping back above 4% as markets priced in the inflationary impact of higher oil prices. When the safe haven instrument is itself part of the problem, it stops being a safe haven. It just becomes a different kind of risk. Tool 3, commodity exposure. Oil, natural gas, agricultural commodities. These can hedge against supply shocks, but they are operationally complex, volatile, and directly correlated to the very geopolitical events that create the risk. You cannot easily put $300 million of corporate treasury money into oil futures without creating enormous operational and regulatory complexity. Now, I want you to think about what a corporate treasurer actually needs. Not what sounds good in a Bloomberg headline, but what a finance committee responsible for protecting billions in corporate cash actually requires. They need an asset that is geopolitically neutral. Bitcoin has no issuer, no central bank, no sovereign authority can freeze it, sanction it, or devalue it through monetary policy. In a world where the US and Iran are actively in conflict, where entire banking relationships can be severed overnight, where swift access has been used as a geopolitical weapon, an asset that is neutral to all nation states is increasingly valuable. Gold tries to be this. Bitcoin actually is this, at a level gold cannot reach. They need an asset that is borderless. Bitcoin can be transferred between custodians in any jurisdiction within minutes without the friction of wire transfers, correspondent banking relationships, or cross-border regulatory hurdles. For a multinational corporation, this is not a minor feature. It is operationally transformative, and they need an asset with a hard-capped supply. This is the most underappreciated property in the entire Bitcoin thesis. And I need you to hold this thought carefully, because it is the engine behind the supply scenario I'm about to show you. There will never be more than 21 million Bitcoin, ever. That is written into the protocol at a level that no war, no government, no central bank, no Fed decision can change. At the moment that Bitcoin was sitting near its all-time high of $126,000 in October 2025, that supply cap was as true as it was when the first block was mined in 2009. The supply cannot respond to demand. In a world of $38 trillion in US debt, In a world where governments reliably respond to crisis with monetary expansion, a hard-capped asset is structurally different from everything else that sits in a corporate treasury portfolio. Larry Fink of BlackRock stated it plainly. If investors lose confidence in U.S. fiscal management, Bitcoin could become a viable alternative to the dollar, a digital form of gold, but with properties gold cannot match. That is the world's largest asset manager making that argument in a research document sent to institutional investors. The Hedge playbook is changing, and the supply math behind that change is what I have been building toward this entire video. The next section is the one you showed up for. Stay with me. This is the part of the conversation that most financial media skips, because it requires patience and because the conclusion it arrives at is genuinely uncomfortable for anyone who has been dismissing corporate Bitcoin adoption as a niche trend. Let's do the math together, carefully and conservatively. The S&P 500 is a universe of 500 major U.S. publicly traded companies. Collectively, these companies hold approximately $3 to $4 trillion in cash and short-term liquid instruments on their balance sheets at any given time. Apple alone historically holds over $150 billion. Microsoft, Alphabet. The list of cash-heavy balance sheets is very long. Now here's the scenario I want you to think through. It is not a prediction. It is a plausible structural scenario based on the infrastructure that is now fully built, the regulatory environment that now supports it, the macro pressure that is now active, and the geopolitical trigger we are living through in real time. Geopolitical tensions, specifically the ongoing US-Iran conflict and its ripple effects across energy markets, deficit spending, and currency debasement risk, push corporate treasury committees at 30 to 50 mid-cap S&P 500 companies to approve a Bitcoin allocation of just 2% of total treasury reserves. Not the mega caps, not Apple or Microsoft, mid-cap companies with $500 million to $2 billion in treasury assets, quiet allocations, institutional-grade execution through ETFs or direct custody, announced in an 8K filing barely noticed by the financial press. 2% of a $1 billion treasury is $20 million. Across 40 companies, that is $800 million of new buying pressure entering the market. But here is what makes this truly important. It is not just the dollars. It is the signal. Bitcoin markets run on narrative and available supply. When corporations announce treasury allocations, even modest ones, it communicates to the rest of the market that the institutional assessment of Bitcoin has shifted. It reduces perceived risk. It creates a permission structure for the next cohort of companies to follow, and the cohort after that, and the one after that. Now, combine that signal effect with the supply reality. There are only 21 million Bitcoin, ever. Of those, roughly 3 to 4 million are estimated to be permanently lost. Wallets with forgotten keys, early miners who discarded drives. The supply available for new corporate buyers is not infinite. It is not even abundant. It is structurally constrained in a way that has no precedent in any other asset class that a corporate treasurer has ever worked with. When a new class of corporate buyer enters the market simultaneously, motivated by the same macro fear trigger, the supply shock dynamic is real and it is mathematical. This is not narrative. This is arithmetic. We have seen versions of this before. When institutional demand for gold surged in 2020, gold rose from $500 an ounce to nearly $1,200 in months, even though gold supply was not meaningfully constrained. New gold can be mined. Bitcoin's supply cap is written in code. The comparison between the two assets in a supply shock scenario is not even close. The Cambridge Center for Alternative Finance found that corporate treasury Bitcoin allocations typically range from 1% to 5% of total reserves. Even at 1% across a meaningful portion of the S&P 500 universe, the supply math becomes very difficult very quickly for anyone on the outside, trying to buy in later. And here's the thing that should be occupying every serious corporate treasurer's mind right now. If you are sitting on a treasury and watching gold at 5,390, having missed the entire run from $2,000, watching Bitcoin at roughly $69,000, having missed the run from $16,000 in 2022 and the surge to $126,000 in late 2025, you're acutely aware that the next macro shock cycle does not wait for you to complete your due diligence. The infrastructure is built. The accounting rules allow it. The regulatory environment supports it. The precedent has been set at the federal government level. The geopolitical trigger is not a hypothetical. It is active. The only thing left is the decision. Let's bring this together. Conflict leads to spending. Spending leads to deficits. Deficits lead to bond issuance. Bond issuance leads to currency debasement risk. That cycle has defined every major war era of the 20th and 21st century. But 2026 is different. For the first time in modern financial history, there is a liquid, borderless, hard-capped asset sitting inside the institutional system. Over $54 billion in ETF infrastructure. 194 public corporations holding it. U.S. strategic reserve status, institutional custody, FASB compliant accounting, board level approval pathways that didn't exist 3 years ago. Gold is doing what gold does. It ran to $5,295 in January. It's near $5,390 today. Even JP Morgan Chase sees $6,300 by year end. Gold is working. But this next macro leg isn't only gold's story. Some corporations are beginning to understand the difference between a hedge exposed to sovereign custody risk and one that is borderless, supply constrained, and programmatically scarce. And they're acting quietly, systematically, with urgency. There were 0 public companies holding Bitcoin in 2019. There are 194 today. They won't be 194 in 2030. The only real question is this: where are we on that adoption curve? And what happens to supply when the next cohort moves at the same time? Everything we covered, debt cycles, corporate treasury shifts, supply dynamics, geopolitical triggers, connects to one framework. Your financial life must be structured to survive and thrive across regimes, not just Bitcoin, not just gold. A layered strategy built for inflation, deflation, war premium, or risk-off panic. That's what I call the wealth continuum. It connects macro reality to actionable allocation, from liquidity to alternatives to long-duration assets, in a way that works regardless of what geopolitics does next. If this gave you a new lens on what's happening, hit like. Subscribe if you're serious about tracking where this goes next. And share this with someone who manages real capital, because the framework is what matters. I'll see you in the next one.